Hi everyone. Today we're diving into two powerful concepts from ICT's toolkit that can give you an edge in your trading: breaker blocks and mitigation blocks. These are one of my favorite PD arrays to trade, especially the breaker block. I'm going to explain how I interpret them and how I incorporate them into my trading. Stay tuned all the way to the end because I'm going to drop some gold nuggets along the way. Okay, so first of all, let's go through what both these PD arrays look like and what differentiates them because they are relatively similar and how they are used is practically the same. Okay, on the left, we have a breaker block and on the right, a mitigation block. These are both bearish examples. So for a bullish example, you just gotta inverse the chart. Okay, so they're both reversal profiles on the time frame you are seeing them on. So if you see a breaker block, this is a reversal profile. And if you see a mitigation block, that's a reversal profile as well. But you have to be in line with the higher time frame. Okay. If you see a breaker and suddenly price continues to move higher, that doesn't mean the breaker doesn't work. Okay, that means a higher time frame narrative and institutional order flow is taking place. All right, so the actual zone to take trades from, or even an entry from, in this instance of the bearish example, is the nearest up candle or series of up candles after price makes a lower low. So when you see price make a higher low, a higher high, and then it breaks that market structure to the downside with a good displacement. The breaker block would be the down candles, the up candles, the down candles, sorry, before the up move and after price breaks down. So when price is like this, taking a trade from a breaker would be in this zone. For a mitigation block, it's also relatively similar, except price does not make a intermediate high and then take that high. It just goes straight up and then breaks down, comes back up either to fill an imbalance or an order block, breaks down, and then a trade can be taken at the same general area. The defining difference is that a breaker raids liquidity on its respective time frames by making a higher high or lower low in a bullish example before reversing. Okay, so there's liquidity up here. Sometimes it forms equal highs or a consolidation. It takes that out with a displacement, usually at a time of medium to high impact news, or sometimes at session opens or during certain times of the month as well, depending on what time frame you're viewing the breaker on. Okay, so the reason why I like trading breakers more and why they're a higher probability is because they take out some short-term liquidity as well, equally as well as going into a higher time frame imbalance or liquidity zone. Okay, so having a top-down analysis and a higher time frame POI helps you increase the probabilities of your trade. However, in the mitigation block, we see price come into that zone, but it does not take out short-term liquidity. In this case, one may look at a correlated asset and see if there's an SMT divergence, meaning another asset. For example, if I was looking at the British pound Canadian dollar, for example, on this chart, if I were to see a mitigation block on a British pound Canadian dollar, but on the Euro Canadian dollar, there's a breaker. One may use this as a confluence either to still take a trade on the British pound. As you should know by now, if you're already learning about PD arrays, such as these, is that the market moves from one area of liquidity to another. So if you don't know what liquidity is, stop this video and educate yourself about that first, or you will be doing yourself a disservice, because that is, that is the core principle of ICT's concepts, one of the main core principles, and is generally just a fact of the market, that big institutions or any trader requires liquidity to get in and out of their positions. Okay, and of course, especially larger entities, which require a lot more liquidity. So let's go see some real examples on the chart. Later on, I'll give you a simple mechanical way to trade these PD arrays, as well as a discretionary approach, which I personally use. And of course, some tips on how to increase the probability of your setups. All right, so this is the British pound Canadian dollar chart on the 5-month time frame. Okay. When it comes to looking at PD arrays, I often shuffle through various time frames to see which one looks a bit more clean and a bit more clear. So this is one little tip that you can use as well when it comes to looking at your PD arrays. Um, Even if I find a good looking setup, a good looking PD array on one time frame, I will still check the other time frames to make sure that this PD array is reflecting my my bias on all additional time frames. So on this time frame, it's the 5-month chart, and I found a breaker down here. Okay, a mitigation block and another mitigation block. Now, within a mitigation block or any PD array, on a lower time frame or a higher time frame, there could be a different PD array. So inside a fair value gap, it could have a breaker, and inside that breaker, there could be an order block. Inside that order block, there could be a fair value gap. Inside that fair value gap, there could be a rejection block. So it just goes on and on as price is fractal. So another tip is having the confluence of multiple time frames is very useful in your analysis. So, but staying on this time frame of the 5-month, we see a mitigation block down here and an order block / mitigation block here. So we see price breakdown of the structure, taking out this trend line liquidity as well. Okay, if you don't know about liquidity, definitely go and learn about it. Okay, so liquidity is basically where orders are residing. So price quickly trades through this area relative to this time frame, and then stops here at an order block, and then retraces into a mitigation block, basically. And you can see how the bodies are respecting this mitigation block, even though you see wicks going above and beyond. I have a video called "The Bodies Tell the Story and the Wicks Do the Damage." This is a phrase that ICT has used a lot, and I made a video explaining it in more depth as well. Okay, so that's also something you should look up. So when price retraces to this mitigation block, it breaks down and creates another mitigation block. Now you see price trade into it almost immediately, but this is not on the general structure of the time frame it's on. Okay, there's no structure here, and not enough time has passed relative to this entire order block mitigation block for it to not trade back into there to create efficient market movements. Okay, so the market always wants to be efficient. So you see price break down all the way here, comes all the way up into this mitigation block, as well as a fair value gap up here, to be more precise, before breaking down and creating this breaker. Okay, so some people say, oh, breaker has to take external range liquidity. I don't think so. There's liquidity up here, and this is a higher time frame overall structure compared to this one. Okay, so when it comes to labeling your breaker or mitigation block, it's at your discretion. So we have this down candle before the up move and then the break of that, hence getting the breaker. So one could just highlight the bodies of this down candle. I'm encompassing the high here and the high of this green candle and the low of this down candle here. You could take the entire up candle before that, or you can just take the entire range of the down candle. It's not too crucial, okay? I do find bodies have more significance than wicks, so often I may just highlight the body in this instance. And when it comes to observing bodies, I want to see the bodies as well when price trades back into them. So you can see the bodies here. They are respecting this mitigation block. They're not trading out of it. So most of the time, this is the case. Sometimes you see bodies trading outside of these PD arrays. The same goes with fair value gaps. You want to see the bodies respecting the fair value gaps, your order blocks, etc., etc. It doesn't matter what the wicks do. Okay, so going back to this breaker block, see price break structure, and price returns into it. Okay, in this case, it returns to it for a long time before finally breaking down. Okay, so does this mean the breaker didn't work? No, of course it is. And I'm going to show you how to increase the probability of your PD arrays. This can apply to any PD array, as well as targets and the grading of these targets based on probability, what's most likely to happen. Okay. So let me show some things that I was hiding. So I'm going to show you, first of all, targets. Where would I target? Okay. So the highest probability target of taking a trade inside of a breaker, depending where you take it, let's say, for example, at the midpoint. And the highest probability, disregarding the negative RR of this trade, okay, one could always put their stop loss at the high of the PD array of the mitigation block or breaker block. Generally, they will hold. If you have more confluence of other PD arrays stopping price, that's even better. For example, this wick here could be an order block, and you could have your stop loss here to be even more safe. But price generally shouldn't trade back into that zone. So let's say you did that and you have an RR 1.74. The highest probability target would be the external range liquidity. So you see this entire range here. Price trades into it, fills in an imbalance, and then trades lower. So it actually comes, if you didn't take this trade here to target this low, so if you took this candle, you can target this low. If you caught it later on at a higher point of time, you can target the lowest low. So that would be internal range liquidity inside this range, hence internal range. Trading it to external range liquidity, which would be a swing point. Okay, so the next highest probability target would be more discretionary. Would be these equal lows down here. See this multiple lows down here, and this is a large pool of liquidity. Price is drawn to these areas, so this is also a relatively high probability target. Now, bear in mind that you want to have the overall higher time frame narrative order flow in your favor. Okay, if it's not, then of course you're gonna lose more trades, but that's fine. This all comes with experience, and it all comes down to the type of trading that you want to do. Like I said, I'll show you a mechanical way of doing it and a discretionary way of doing it. So this would be a more discretionary way, targeting these equal lows, highest probability. You could take partials here. That's up to you and your strategy. These equal lows. There's also a structural low, so a breaker making a new low, which would be down here. And of course, a larger, more broader outlook of the equal lows here. So what do I mean? This low to this low are relatively equal. Okay, this is also a pool of liquidity. Price did not take out the liquidity below these lows. The orders below here were not taken out. So traders are feeling quite happy now that price is going up, and you know, some may stay in their position, some may exit the position. It doesn't matter because this low is not yet rated. So in the eyes of I guess the majority of traders out there, this would be seen as a strong low. It would be seen as support, and they would try and trade it, I don't know, higher, right? But for us ICT traders, we see that as a big magnet down here saying, come and get me. I am liquidity. Okay, so although price has a big expansion, increases consolidation, lovely equal lows amongst equal lows. Price finally comes down and takes that, and you can get a decent trade off of that. This is how many pips? 2,000, 3,000, 3,500 pips, which is quite a lot. It's a decent amount of pips. You see many traders trying to catch 5 pips, 2 pips here or there. Yeah, go look in the higher time frame and get more in line. Okay, so let me show you how to increase your probability of your trades. So over here, you can mark out the range, premium and discount. Okay, I'll just delete this position too. Okay, from top to bottom, premium to discount. And you see price come back into equilibrium, the midpoint. Okay, so it's a 50% of a fib basically, or the midpoint of an entire range. Price comes back to these areas very, very often. So one could wait and take a trade from there, and also likewise increase their RR, right? If they had to have their stop at the high because they feel safer and target the low, at least they can get a 1R type of trade. All right. And another strategy I deploy is trading breakers which have gaps. To me, this increases the probability of a setup, because when you start stacking PD arrays on top of PD arrays, it increases the likelihood of that PD array holding. Okay, more confluence. So we have it's gonna hide this here. You see this gap here, which has a breaker inside. This is called a unicorn gap, which is basically a breaker with a gap. So one could take a trade here to here or here to here. Whatever your strategy is, that is completely up to you. Okay, so this is a more discretionary approach. Of course, one could go to a lower time frame. So I'm going to go to the weekly now, and we can see a bit more here, right? On the weekly, you wouldn't use things so much like kill zones and news events as much, but for example, you were looking at this chart, trying to find a refined area to take a trade. So you see price come up, drops all the way down. There are many areas one could trade, right? If you believe this was the top, you could have a refined entry at this new week opening gap. You see price trade in, break down and trade into a fair value gap. You could take a short there, take profit, up to you. But as you see, as price creates more structure, especially in the higher time frame, it comes up to this order block at the midpoint, order block over here. Very nice. Almost to about the midpoint of that order block and the equilibrium, remember? And then breaks down. And that was the highest point. Okay, seeing if you didn't, and you see a breaker here as well. Trades into internal range liquidity. You can put the range here as well. Okay, look at that. Equilibrium again. A breaker with a gap. A breaker inside of a breaker. Okay, breakerception. This is a beautiful one as well. So you can take trades on any time frame, okay, but have that top-down analysis in mind. So if you see a breaker that suddenly start to shoot up, you're like, okay, wait a second. Let me go to the higher time frame and see what's up. Let me see if there's any pools of liquidity, drawing price, etc., etc. So you see some equal highs being created here. Okay, it makes a high here, a high, takes it out a little bit. So people that trail their stop, they're out now, and damn, they are angry because price is just flying. Um, Perhaps they're FOMOing in here, trying to catch a little bit of that short. And what does it do? Starts shooting all the way up. They think it's a reversal. Equal highs are created again. This is why you don't you don't chase price, because the market is designed to basically take liquidity from such people and make them lose. Finally, a sharper stab. This was the next high, intermediate high. Price consolidates more, creates this sell side liquidity here, taps it a bit, retraces into, I wouldn't call this a breaker. Okay, let's just call it order block and a gap in here. If you can see it, if you're on your phone, I'm sorry, it might be a little bit small. And then leaves. And what do we have here? Equal lows, sell side liquidity. Even considering this, it is all a pool of liquidity. This general area is just asking to be taken out, and price does it violently, okay, properly, this time with bodies and over time. And that was the final stab that took out all the 3 other discretionary targets. Okay. Yeah, for a broader outlook, one could even target more if there were other higher time frame PD arrays to the left. Okay, likewise, go back to the 5-month. We see the breaker here. Where does price want to go? Now, let's say we didn't see it coming up, and perhaps it wants to go lower. Maybe there's a higher time frame, fair value gap, relative equal lows, etc., etc. It's all fractal, and you're all basically looking for the same thing. But price comes back up into this zone. What for? I don't know. We'll have to see. Go ahead, if you want to experiment yourself with this pair, go ahead and look on the higher time frames and see what you see. See where it looks like price is going to target. Okay, that's a discretionary approach. Going to different time frames, taking trades there, perhaps either to catch a higher RR trade or just to catch a trade in between that doesn't take so long to pan out. Okay, this is a 5-month time frame. Yeah, it takes almost like 7-8 years for this whole for the breaker to actually properly go to all these targets. So that's why you want to catch breakers on lower time frames. Okay, and that's why breakers are higher probability setups as well. So a more mechanical approach that you can deploy is not having this top-down analysis and just finding breakers and just basically taking them with a set amount of criteria. Okay, so like I said, you can have a entry at the midpoint of the breaker, and you could have your stop at the high. You could have an entry at the midpoint, your stop at the high of the entire range. Okay, or an entry at the midpoint of the entire range as in equilibrium and targeting that low. All right, this would be a mechanical way of trading, and you wouldn't be so mindful of the higher time frame. But bear in mind, it's better to catch these type of trades not on the 1 minute, because you're dealing with slippage, which is going to eat up a lot of your RR, and of course decrease your win rate. So you want to be on a decent time frame and be aware of the commission and slippages you may encounter, and just take trades there based off a mechanical set of rules, not worrying about higher time frames and stuff. Whilst your win rate may be lower, it doesn't matter. Obviously, if you have a decent enough win rate and RR, and you're consistently profitable and you can follow the mechanical rules, you can make lots of money. Any strategy can scale, to great lengths, if there's a decent edge and the rules are being followed. So that's a more mechanical approach, utilizing premium discount, fair value gaps, and having just basically rules that you consistently follow and have backtested, of course. Don't just implement rules for the sake of it. Backtest them. You can use the TradingView replay tool It's completely up to you as well. So yeah, those are basically it. They are basically the down candles before the up move. And in the case of a mitigation block, yeah, it is the down candles actually um, before the up move that breaks down. Yeah, so personally, mitigation blocks for me, I use it more for the higher time frame analysis, but breakers, I do utilize it more, especially ones with fair value gaps, which are generally called unicorn setups. These are the highest probability ones. So if you were to create a mechanical trading strategy, I'd recommend using breakers more and perhaps add additional rules such as price coming into a premium of a recent range within that time frame, or OTE, which is optimal trade entry. Okay, which is basically from the 62% to the 79. This range is generally called optimal trade entry, which ICT uses. Um, have that higher time frame narrative to increase the probabilities of your setups. But at the end of the day, do something that you can do. Don't try to make it too complicated or too fancy when you don't know what you're doing, when you don't have the discipline to follow it, or even just as a human, you don't have the mental capacity to even execute those things consistently, right? We're all human. We're not AI or some sort of computer. Okay, so we have to kind of cater to our subconscious abilities in recognizing patterns as well as our conscious abilities in executing. So that's it for this video. I hope you found it insightful. And yeah, I have more videos like this on my profile as well on TradingView or on YouTube. So feel free to check it out. Till next time, take care, guys, and trade safe.